There's an age-old, unbreakable iron rule in global capital markets. 7 lose, 2 break even, 1 win. Out of 10 people who rush into the stock market, 7 will end up with real net losses, 2 will walk away with no gains, having wasted their time and paid nothing but trading fees. And only 1 will ever earn truly consistent long-term profits. Of the 70% who lose money, over 90% are what we call retail investors. Everyday people with no institutional backing, no professional team, putting their hard-earned money on the line. It doesn't matter if you're a straight-A student with a 150 IQ, a top executive with $1 million annual salary, or a shrewd, cost-conscious small business owner. Once you step into this brutal arena of the stock market as a retail investor, odds are you'll be left with nothing but the shirt on your back. Have you ever wondered why? Why is it that you'll spend half an hour comparing prices on household goods at the grocery store? But when it comes to your hard-earned savings, tens or even hundreds of thousands of dollars, you'll see a post on Reddit or a story in the Wall Street Journal and hit go all in on your trading app without even 3 seconds of thought? Today, we're pulling back the shiny curtain of the stock market, using the most unflinching perspective and fundamental logic to break down a brutal truth. Why retail investors always make up the vast majority of losers in the stock market. This isn't mysticism, it's an all-out dimensionality-reducing onslaught of capital, information, technology, and human nature. If you're currently trapped in losing positions or gearing up to dump your life savings into the US stock market, make sure you watch this video all the way through. These next 0 odd minutes could save you a decade of hard-earned money down the line. The first step to losing money for most retail investors starts with an illusion. The illusion that I'm on a level playing field with Wall Street institutions. Wake up, buddy. You think you're playing the same game of chess, but they're playing StarCraft with full map hacks enabled. Let's start with the information gap. Why do you buy a company's stock? Because you saw a headline on CNBC, a tweet from a market guru, or because the stock has been up for 3 days straight? You need to understand, by the time a so-called market-moving positive news reaches your phone screen via media outlets and social posts, it has already passed through countless layers. Insider sources, hedge fund managers, top Wall Street analysts, and big money traders. You are at the very bottom of this food chain. By the time you're sitting on the toilet reading huge positive news by now, the quantitative algorithms at high-frequency trading firms have already built their positions in microseconds, and are even getting ready to dump their shares at a premium to you, rushing in on the news. This is why retail investors constantly run into the phenomenon of good news when released becomes bad news. The second you buy, the price drops. Because what you're buying is the sell-off from players cashing out their profits. Let's look at how top hedge funds conduct their research. To study Tesla's production capacity, they'll purchase commercial satellite imagery to compare vehicle density at the Gigafactory parking lot every single day. To analyze a retail giant's earnings, they'll buy anonymized credit card spending data from millions of consumers to forecast results ahead of time. And you? You look at a 5-minute candlestick chart and a post on a retail investor forum, slap your knee and say, "This company has huge potential, buy." You're trying to beat people armed to the teeth with professional expertise, using nothing but your after-hours hobby. Who else is going to be the bag holder if not you? If the information gap sounds devastating enough, what comes next is even more fatal: you yourself. The stock market is, at its core, a deeply counter-human mirror. The survival instincts we've evolved over millions of years are all fatal flaws that will drive you to bankruptcy in the stock market. Nobel Prize-winning economist Daniel Kahneman's prospect theory perfectly explains how retail investors sabotage themselves. The first flaw is loss aversion and the disposition effect. Psychological research shows that the pain humans feel from loss is twice as intense as the joy from an equivalent gain. The agony of losing $100 takes a $200 win to offset. In the stock market, this translates to the classic terminal illness of retail investors. Cut your profits short and let your losses run. You buy shares of a great company like Apple or Microsoft, make 10%, and can't sleep at night from anxiety? So you sell immediately to lock in gains, perfectly missing out on the multifold gains that follow. But when you buy into a dying sunset company on the brink of collapse, you hold on tight when it drops 50% and even try to average down when it's down 80%. If I don't sell, I haven't lost. Institutions cut their losers and hold their winners. Retail investors pull up the flowers and water the weeds. The second flaw is the fear of missing out. better known as FOMO. There's a saying in the stock market: the most painful thing isn't losing money yourself, it's watching your clueless neighbor make a fortune. When a raging bull market hits, social media is flooded with people posting their wins and their doubled portfolios every single day. Your rational brain tells you the market is massively overvalued, but your dopamine is going into overdrive. Eventually, you snap, dump your entire life savings into the market, and dive in head first. This is where the famous shoeshine boy theory comes in. On the eve of the 1929 U.S. stock market crash, Wall Street tycoon Joseph P. Kennedy Sr. was getting his shoes shined on the street when he noticed the young boy shining his shoes was excitedly giving him stock tips. Kennedy had a stark realization. When even the shoeshine boy, the person with the least financial knowledge at the very bottom of the social ladder, was talking non-stop about making money in stocks, it meant all the money that could possibly enter the market was already in. The bubble had reached its absolute peak. He went back to his office and liquidated his entire stock position, successfully avoiding the Great Depression that followed. When the shoeshine boy is giving you stock tips, rushing into the market guarantees you'll end up as the proud bag holder. The third flaw is dopamine addiction and overtrading. The fluctuations of the stock market operate on the exact same random reward mechanism as a casino slot machine. You make $500 today, lose $300 tomorrow. This unpredictability floods your brain with dopamine. Retail investors often treat the stock market like a casino, addicted to the rush of clicking a mouse and watching tens of thousands of dollars move up and down in an instant. But excessive, frequent trading doesn't just leave you fully exposed to the random noise of the market. It also introduces the invisible vampire of trading frictions. What most retail investors don't realize is that short-term stock trading is, by nature, a negative-sum game. Even with zero-commission trading, Wall Street market makers siphon money out of your pocket through the bid-ask spread and payment for order flow, without you even noticing, not to mention the capital gains taxes you'll owe. It's like playing a coin flip game in a casino that charges a steep entry fee every single day. Even if you have a 50% win rate, over time you are guaranteed to go broke. On top of that, retail investors always fail to grasp the simplest math, the brutal, unforgiving arithmetic of market losses. Let's say you start with $100,000 in principal, lose 10%, and you're left with $90,000. You need an 11% gain just to break even, lose 20% down to $80,000. You need a 25% gain to get back to even, lose 50%, and you're at $50,000. How much do you need to break even? 100%. You need to double your money just to get back to where you started. Lose 80% down to $20,000? You need a 400% gain to break even. Anyone who's traded stocks knows just how hard it is to find a stock that returns 400%. Wall Street institutions understand this math perfectly. That's why they have extremely strict risk management systems. The second a position hits its stop-loss level, their algorithms automatically liquidate it, no emotion, no hesitation. And retail investors? Their risk management basically relies on blind faith. Their favorite move is averaging down on a losing position, trying to lower their average cost, only to get wiped out entirely in the end. Remember the famous Wall Street saying, "Never try to catch a falling knife." To ease their anxiety, many retail investors start studying relentlessly. They buy shelves of books teaching you how to become a day trading guru, learn to draw trend lines, read MACD and Bollinger Bands. They think they've cracked the code to wealth. But this is just another psychological trap, the illusion of control. The human brain is hardwired to find patterns in randomness. You look at a cloud and see a rabbit. You see a stock chart with 3 up days in a row, and you think you've uncovered the market maker's secret playbook. But the brutal truth is, short-term price movements in modern financial markets are defined by an extremely complex random walk. Those classic technical indicators you treat as gospel, in today's era of quantitative trading dominated by supercomputers and AI algorithms, won't just fail to make you money, they've become nothing more than a script Wall Street uses to take your money. Quantitative algorithms know exactly where retail investors like you will buy at a technical support level and exactly where you'll set your stop-loss orders. They will intentionally use their capital to crash through that support level, triggering a mass panic sell-off from retail investors. This is what's known as stop-loss hunting. They scoop up shares at the bottom, then ramp the price right back up. You stare at your screen at the perfect breakdown and sell at a loss through tears. You think you just weren't good enough at technical analysis, but the truth is, you just followed a script someone else wrote for you to the letter. At this point, you might be feeling hopeless. You can't get information faster than institutions. You don't have the capital of hedge funds. Your human brain is full of cognitive biases, and your technical analysis is completely outmatched by AI. So does that mean retail investors have no chance of winning in the stock market? Wrong. Retail investors absolutely can make money in the stock market and make it consistently and safely. But only if you completely abandon the short-term trading game Wall Street has set up and use the unique, asymmetric advantages that only retail investors have, your own dimensionality-reducing weapon. To turn the tables, you need to memorize these 3 unbreakable rules. First, accept your limits, and if you can't beat them, join them. Abandon market timing and individual stock picking and embrace broad market index funds like S&P 500 ETFs or NASDAQ 100 ETFs. You need to accept that you don't have the ability to pick the next NVIDIA out of thousands of public companies, and you can't predict whether the market will rise or fall after the Federal Reserve's speech tomorrow. Even less than 15% of top Wall Street fund managers can outperform the broader market index over the long term. Legendary investor Warren Buffett once made a famous million-dollar bet that no hedge fund could outperform the S&P 500 index fund over a 10-year period. In the end, Buffett won. When you buy the S&P 500, you're essentially buying a basket of the world's top companies. As long as the global economy keeps growing, the index's built-in survival of the fittest mechanism will automatically kick out failing, bankrupt companies and add rising, high-quality ones. You don't need to read financial reports, you don't need to understand stock charts. All you need to do is use dollar-cost averaging. Second, lengthen your time horizon and use time to unlock your upside. Wall Street institutions' money has a cost. Fund managers face brutal quarterly performance reviews, and they're under immense pressure to deliver short-term profits. But you don't. As long as your money is idle cash you don't need anytime soon, you can hold on for as long as it takes. Hold for 5 years, 10 years, never sell. Who can force you to hand over your shares? Time is the only weapon retail investors have that gives them an overwhelming advantage over Wall Street. As investing legend Benjamin Graham famously said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." Abandon the fantasy of getting rich overnight and be a friend to time. Third, and the most important one of all, the greatest leverage you can ever apply is to yourself. Too many retail investors spend 8 hours a day staring at their screens, obsessing over every tiny price move, yet won't spend 30 minutes improving their professional skills. The truth is, for the vast majority of ordinary people, the best investment you can ever make is not in Tesla, not in Bitcoin, but in yourself. Your day job, your core skills, those are your real cash cow. The one that generates a steady, endless stream of cash flow. Pull your energy away from staring at the market and put it into learning, into getting in shape, into spending time with your family, into building your ability to make money outside of the stock market. Use the money you make outside the market to consistently dollar-cost average into high-quality index assets. This is the most reliable, most powerful path of compounding for ordinary people to move up the social ladder and achieve financial freedom. The stock market is never an ATM for ordinary people. It is a purgatory for human nature, a meat grinder for wealth. It punishes greed, it punishes fear, it punishes ignorance, and it punishes anyone who tries to take a shortcut. But if you can recognize your own limits, overcome the greed in your heart, replace emotion with discipline, and replace impatience with patience, the stock market can also become a compounding machine for building lifelong wealth. There's no shame in admitting you're an ordinary person. What's truly tragic is refusing to accept that reality and losing your entire life savings as a result. If this video gave you even the slightest bit of insight, even if it just stopped you from dumping your entire portfolio into the market tomorrow, please hit the like button or share this video with anyone you know who's trading stocks. Every like you give is the biggest support you can offer me. If you want more in-depth, no-nonsense content on the true nature of business and the fundamental logic of finance, don't forget to subscribe and hit the notification bell. I'll see you in the next video.